with the chief strategist of Davis Ray. John Johnston joins me on the line now. Now, let's not debate each other because then they'll have to decide which one of us fits which category there.
Yeah, I seem to self-select into the latter one always.
Well, I'm putting you in the former category.
Thank
there you go. John, great to have you on, by the way, but there's so many things I wanted to chat with you about, and it starts with the big one, and that's the Canadian dollar. You know, I just review for people. Seriously, I didn't know another analyst when we were sort of talking about a Canadian dollar drifting down to 88. You said, no, I think it's much weaker than that. It's going down to 70. And I felt you were absolutely right on with that. We got to that 78-cent mark. You come to the World Outlook Conference, and I think you've described perfectly what's gone on since then. And you said, you know what? I think we're getting a good bounce here. But that's where I'm kind of puzzled. Is this the beginning of a bigger thing than a bounce, than a correction to that down move? Or should we expect just another revisit downward?
Yeah, I'm puzzling it out as well. When I initially put that 70-cent target out there, I had that in mind as a longer-term target, and we got there pretty quickly. I think that my view was when I was out with you in Vancouver in January was that we were going to get a bounce, but there was another down leg coming, and there was a good chance that down leg would probably take us below the January level of 68.07 U.S. cents. And one of the things I'm very impressed with is how strong the rally in the Canadian dollar and the commodity space and in the equity markets has been. If you look at it with the technician's hat on, it kind of suggests that we've seen the lows in a lot of these things, and that we're probably, after we go through what I would classify as an intermediate correction, that it's probably starting now, takes us through the summer, maybe even into the early fall, but then we generally have stronger markets, including a stronger Canadian dollar going forward. And a couple of things I'm focusing on here, one of which is the wipeout in commodity prices and oil in particular and gold in particular in the early part of the year and in the Canadian dollar all have a feeling to me very much like 1986. You know, we had the big run up in commodities in the Canadian dollar in the 70s. Then you had the big bust in the 80s, and you had a big rebalancing of demand and supply. And think about it in the oil market. We had the North Sea come online as a supplier. Mexico came online as a supplier. And we had a fair amount of demand destruction. And oil went down to $9.75 a barrel, and the Canadian dollar kissed 70 cents for the first time. We then had a fairly significant rebound. We didn't end up going way back up in the Canadian dollar and in oil prices back to the old highs, but we certainly had a nice rally that lasted, a couple of years. We moved into a higher trading range for oil prices, for gold prices, and a range of commodities, and the Canadian dollar basically went up 20 cents from 70 cents ish to around 89 cents. And I'm kind of wondering if we're going to replay that now. So I think we get an intermediate. We're in the early stages of an intermediate, Canadian dollar falls down, 73, 75 cents maybe, sometime through the summer, and then we get a bounce. And I'm still a long-term bear on the Canadian dollar. I think in a world that's kind of becoming deglobalized, where tariff barriers are more likely to go up than down, a trading nation like Canada is going to be in big trouble. And, we haven't done very much on the innovation side. We've raised taxes. I think that there's a long-term view out there where the Canadian dollar will hit a new historic low, but I'm kind of wondering whether we move up towards the 90-cent mark over the next 18 months, and commodities and the commodity sectors outperform. The TSX outperforms the S&P on a currency-adjusted basis, and we have a bit of a run here.
Well, I mean, obviously there's, with the volatility we've had, it's produced these huge money-making opportunities if you get on the right side of these moves. I mean, the down move, I don't know if I did anything better than simply convert my Canadian dollars into U.S. dollars going back quite a while now, October 2012 and before. I just had to do that. I didn't have to do much with it. But if we get a bounce, as you say, that could have, let's say, run a little further and faster than most people anticipate, into 90 cents, I mean, again, that's a huge opportunity.
Yeah, it is. And if you think about it, there's just so much money sloshing around the global financial markets. The central banks have created enormous amounts of liquidity. They're basically making free money available to people, and it's not going into the economy. It's going into financial speculation,
Sure.
by and large. Those things pushed oil up above $100 a barrel, crashed it down to whatever the low was, 25, and pushed the Canadian dollar down, almost 40 cents over a 3-year period. And we run the risk here that they end up getting on the other side of it and they push it up. And one of the things that kind of gives me a sense of that might happen is the industrial stocks in the U.S., which is a sector that we like from a longer-term thematic perspective. Some of these stocks were down 35% in January, and they've just been screaming since then. So the money seems to have gone from one side to the other there, and I wouldn't be surprised if we see that happening on a broader range of assets, including commodities, the Canadian dollar, and probably the emerging markets to a degree.
Let's come back to one other thing you mentioned there, and that is you're watching both presidential candidates in the U.S., or presumptive candidates, let's say. You actually can go further. If Mr. Trump is a presumptive Republican, well, it looks like Ms. Clinton, although unless she gets indicted first, and or Bernie Sanders. Well, all of them have been talking about, I would call them anti-free trade scenarios. And as you said, Canada can ill afford that given the degree to which our exports create our standard of living.
Mm-hmm. Absolutely.
So
and it's not just...
Sorry. I
no, you go ahead.
Variables that are out
you.
there. Yeah, no, yeah. But those are the variables that are out there, and which makes it easy for me to make a case for the Canadian dollar moving in a lot of different directions.
Oh, absolutely. And, I've had some very vigorous debates about this with people over lunches and client meetings over the past couple of weeks. And one of the things that strikes me, though, is the Canadian dollar has a habit of hitting a major low every 14 to 16 years in January. And last January was, from 2002, was 14 years out from the last one when we went below 62 cents. I find that compelling, and the fact that the U.S. dollar hits peaks roughly around the same time, and it's done that. But I'm thinking back to what Martin Armstrong said at the World Outlook Conference, that we're in a bear market for governments. Yes. And the amount of negative sentiment on the part of citizens towards governments in a whole range of countries. We had our little experiments kind of with some outside-the-box moves with Rob Ford here in Toronto, and the Albertans with Rachel Notley. Was a big outside-the-box move for them. And you've got a clown leading a political party in Italy. The Britons are voting on leaving Brexit. It seems we hit a high water mark back at the beginning of the last decade when China moved into the World Trade Organization, and now we're retreating from that in the midst of economic difficulty. And one of the things is that I still am a believer in free trade, but one of the things that what economics and economists say about free trade is there are winners and losers, and part of the argument in favor of free trade is you have to take care of the losers. And when we originally signed the free trade agreement with the U.S. in 1988, the Mulroney government at the time made the statement, and they were correct, I believe, at the time, was that our social programs would take care of the people harmed by free trade. And then all we did afterwards was got social programs because we couldn't, we blew the budget. So I think that something has to be done on that front to reignite a favorable global view towards trade, and I don't think it's coming anytime soon. So I think it's going to be a big challenge. It's basically we're throwing a huge amount of gravel in the gears of the global economy, and it reinforces my view that the global economic outlook, maybe isn't dire, but it's certainly not going to be as good as it has been for the last 30 years, and global growth is going to be slower than it was, and global earnings growth and dividends growth and inflation is going to be lower, and interest rates are going to stay extremely low, probably for another 5 years at least.
Yeah, it's interesting. It's a very straightforward statement, but I still don't get any sense that most of the public makes any connection between their economic well-being or their financial well-being and a whole bunch of stuff happening economically. And I agree with you that we've set the stage for really a long period of where mediocrity may be the best hope. Mm-hmm. And that has huge implications with a population that's aging, and it's partly due to that, but for government finances. I couldn't agree more that the media in Canada seems absolutely oblivious. They missed who Donald Trump was or why he was. They refuse any culpability for that too, by the way. They elevate celebrities to this ridiculous, put them on pedestals, and then they're surprised that one goes further. But they've missed this thing that this is a trend happening throughout every democracy. I mean, it's rife in Europe, where you've got a party leading Greece that didn't even form 2 years before they took power, and all the other examples you gave. And I just think that's a scenario that people are now forced to invest in. And I got to take a break, but we come back, I'll get John Johnston to make sense of that, what we should do. What does it mean for our money and our investments? And we'll do that in just a couple of minutes with the chief strategist of Davis Ray. Maybe you didn't hear, there's another Clinton scandal just hit the airwaves yesterday with all the familiar ingredients: skirting charity rules for the Clinton Foundation, $2 million in foundation money to a for-profit company benefiting Clinton insiders, but $800,000 that Bill lobbied for of government money goes to that firm while Hillary was Secretary of State. The firm's near bankrupt now, but here's the beauty: the owners of that firm include a significant owner is Bill's mistress. Oh, you can't make it up when it comes to the Clintons. John Johnston is my guest right now, Chief Strategist Davis Ray. John, great overview for us, and I want to come now down to the individual, which of course you deal with on a regular basis. Let's start with, let's say, got a lot of people have got these U.S. dollar holdings. What would you recommend?
Well, it all depends on time horizon and needs for U.S. dollars. But I guess thinking about the outlook I gave on the Canadian dollar, as I see things evolving, if the Canadian dollar settles back down to 73, 75 cents, or just pick 75 as a number, at that level, I'd be inclined to be a buyer of Canadian dollars rather than a seller. And if I was trading the Canadian dollar right now, I'd be inclined to sell some Canada, buy some U.S. And when it kind of pulled back into that mid-70s range, I'd be more of a buyer of Canadian dollars than a seller, on the basis that I think, irrespective of what the longer-term backdrop looks like, it looks to me like we're going to be in a favorable cycle, and I think Canada outperforms. And I think part of it reflects the fact that people were so optimistic about the U.S. economy, the Fed is going to raise rates, and now that underpinning for the U.S. dollar, which was supposed to send it upwards on a longer-term trajectory, is gone. So I think that there's a retreat in the U.S. dollar, and I think we want to stay out of the way of that. And I think that the Canadian dollar looks pretty good, in the mid-70 cent range.
Okay. Let me ask you, are you impressed with what you've seen from oil, or is this, again, a very sort of predictable bounce after a very sharp downturn?
I have a vague sense of what the underlying equilibrium is for oil prices based on reading some of the analyst work, and it's probably, it's way below 100, it's way above 25, and we're coming off this big low, and maybe the equilibrium trading range is 40-60 or 45-65, somewhere in there, maybe with a core around a central tendency between 50 and 60. And the tendency in this market, with this amount of speculation out there, is that you tend to overshoot and undershoot. So I think we generally move back up into a trading range with the risk of some overshoots to the upside of that trading range, and that's going to be beneficial for the Canadian dollar and the TSX.
You alluded to this a few minutes ago. I'll just get you to reiterate. You're not looking for any upward, of significance in interest rates.
No, not at all. The one economy, major economy, where they talk the game about interest rates is the U.S., and I'm hard pressed to see the U.S. raising rates twice over the next 12 months. And I certainly think in Canada, an interest rate increase is not in the cards for years. And I think the risk still in Canada is that interest rates come down rather than go up. So my core view in Canada is that the overnight rate and the return on cash for Canadians in Canadian dollars is around 0.5%, with the risk that it's lower, not higher.
Yeah. Okay, and so let's go to investors. Looking for yield. It's a tough environment, obviously. Wasn't that an insight? A tough environment, though.
Yeah, it is. And the incentive and the pressure on investors who want income is to keep out there on the risk spectrum in corporate bonds, both in investment grade and high yield, and in equities and dividend growing equities. That has some. I think that the markets will be constructive certainly for the next the next 2 to 3 months is going to be tough because of the intermediate correction, but accumulating some equities and some corporate bonds during some upheaval this summer, sets, I think, investors up for a pretty good 12 months following that on that front. And, periods of weakness is a good opportunity to accumulate things and get better longer-term returns. So I think that's going to present itself, certainly as we move through the summer.
Your point about the U.S. is so important, obviously. We're very U.S. dollar focused on this show in that I think it controls so many other things. But I couldn't agree more. They're not going to be able to raise rates the way they suggested. Their economy just keeps on going in fits and starts.
Absolutely.
Yeah.
And the idea here that the ECB, the European Central Bank, is going to continually push rates down and monetize things, that's starting to create some resistance on the part of the Germans, and that's going to create some headwinds for the ECB in terms of how much more it does in Europe.
Well, it's going to be a fascinating time, and I sincerely appreciate your willingness to help us out and make sense of all of this on a regular basis. John, thank you.
It's my pleasure. Thanks, Mike.
John Johnson, Davis Ray, he's their chief strategist, and you can hear why. He's one of the go-to guys for me to get a perspective on what's going on in the currencies, the stocks, but also with the macroeconomic view here.